This chart tracks the S&P 500, showing an 11% V-shaped recovery to new all-time highs. This liquidity influx acts as a structural tailwind for digital assets. Meanwhile, Bitcoin remains in choppy, sideways consolidation, struggling against a heavy horizontal resistance ceiling. This friction is visible across exchange spot prices. Broad market optimism creates a favorable environment, but sentiment cannot overcome local structural barriers. For digital assets, that barrier sits precisely at the $76,000 mark for Bitcoin. Retail participants often assume that because equities are surging, a crypto breakout must follow. However, testing a major ceiling before market mechanics align to absorb selling pressure usually results in a sharp projection. A true breakout requires a sequence of specific mechanical conditions: higher timeframe confirmation, localized indicator resets, and the complete absorption of liquidity. Achieving a permanent trend reversal is an emotionless process that demands neutralizing concentrated supply at a specific price band. We analyze the microstructure of the market by zooming in on the 4-hour timeframes for both Bitcoin and Ethereum. This chart displays the 4-hour candlestick price action alongside the relative strength index. The momentum indicator recently reached the mathematically overbought threshold. In a macro bullish environment, an overbought signal rarely forecasts a structural crash. Instead, it triggers a mechanical cool-off. The indicator drops back toward neutral territory, while the price itself tracks sideways, resisting downward gravity. This consolidation period builds higher local support nodes. Ethereum, for example, used this sequence to establish a floor at 2150. Frustrating short-term chop serves as a necessary mechanical refueling process for the next upward impulse. We rely on the clarity of the 3-day and weekly timeframes to filter out the noise of the 4-hour chart. This 3-day chart identifies the massive horizontal resistance band blocking market progression, marked here at $76,000 for Bitcoin. Wicks testing a level function differently than full candle bodies closing above it. Algorithms often trap retail traders by allowing the price to briefly pierce resistance before pulling it back, leaving behind only a thin wick. A true technical trend reversal requires a confirmed 3-day or weekly candle close that finishes completely above the resistance boundary. Until high timeframe absorption is confirmed by a candle close, price action at resistance remains algorithmic hunting and retail noise. Market microstructure contains a hidden dimension, acting as a gravitational force on the spot price. This liquidation heat map reveals where leveraged traders have clustered their stop losses. A dense pool of liquidity glows just above 76,100, while a dimmer cluster sits at 70,000. Short sellers place their liquidations just above obvious resistance lines to protect their positions. This clustering creates a target for market makers, who require these dense pools to fill large institutional orders. When weighing the probabilities of testing the ceiling versus the floor, the tailwind from the S&P 500 skews the outlook upward. Higher lows established during oscillator resets bias the market toward hunting the upper pool first. Algorithms mathematically hunting the dense liquidity nested just above the ceiling drive the breakout. Evaluating high-cap altcoins like Solana reveals how the broader market is behaving within this macro environment. While Bitcoin challenges its final barrier, Solana currently lacks bullish momentum. For Solana to confirm a trend reversal, it must break and hold the resistance zone between $100 and $105. Lagging assets like this require a much heavier, sustained injection of trading volume in order to successfully escape their current tightly bound price ranges. Broader market movement waits for Bitcoin to act as the icebreaker and shatter the primary liquidity ceiling first. The model is now complete. The S&P 500 tailwind and short-term oscillator resets allow the price to grind into the resistance band. The success of the move depends on the weekly candle closing and holding above 76,000, forcing a cascading liquidation of short sellers. Breaking this resistance opens a void. The lack of historical trading friction allows the price to target the mid-$80,000 range. A confirmed high timeframe breakout converts the heaviest historical resistance into the market's strongest foundational support. One critical risk factor would dismantle this bullish structure, regardless of crypto market mechanics. Digital asset momentum remains beholden to the liquidity environment of traditional equities. If the S&P 500 or the Nasdaq were to suffer a massive structural drop, the scenario changes. In a severe equity dump, the cross-asset correlation exerts massive downward pressure on the crypto market, forcing assets to abandon upper liquidity hunting and fall through local support floors. Technical setups define the probabilities of a breakout, but they exist at the mercy of the macroeconomic foundation.